Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. Today, we're plunging into a stack of compelling financial sources, including comprehensive reports from Bloomberg News, CNBC, Reuters, and even some insights from Jim Cramer's Mad Money. Our mission today is really to cut through the daily noise, extract the most important nuggets of knowledge, maybe some surprising facts, and crucial insights from these headlines. Get ready to become truly well-informed on the powerful forces shaping global markets and economies right now. So let's kick things off by unpacking a truly fascinating story that's, well, it's dominating economic discussions right now. The intricate shifts in global trade, particularly as Washington seems to be actively redefining its relationships with key partners and rivals. While a trade truce between Washington and Beijing might be holding for now, our sources suggest there's a palpable sense of apprehension, in China about what's developing elsewhere.
Yeah, what's really striking here, and this is coming through clearly in reports from Bloomberg News and CNBC, is the clear strategic pattern emerging from the U.S. We're seeing a deliberate effort to forge deals designed not just sort of manage tariffs, but potentially to isolate Chinese firms from critical global supply chains. A prime example is President Donald Trump's recent announcement of a tiered tariff agreement with Vietnam. This isn't just about trade, it feels like geopolitical positioning.
Okay, so this tiered system, how does it actually work on the ground? And I guess more importantly for our listeners, what could it mean for your wallet? Thinking about everyday items like clothing, shoes.
Right. So the Vietnam deal charges exports to the U.S. from Vietnam a 20% rate. Pretty straightforward. But here's the bit that's really interesting, this strategic move, you could say. It's this 40% levy on any goods deemed to be transshipped through Vietnam.
Transship. So you mean like products with parts from China, maybe other places, routed through Vietnam for just a little final assembly before heading to the U.S.?
Exactly. Minimal final assembly. It's an attempt to close a potential loophole. And Bloomberg notes this approach mirrors provisions already in the existing U.S. trade agreement with Mexico and Canada, the USMCA.
So for companies maybe like Nike, Crocs, Lululemon, they rely heavily on Vietnam, right?
Yeah.
This could mean avoiding those much higher direct Chinese tariffs.
Potentially, yes. It could help stabilize prices on their products for consumers, assuming they can navigate these rules effectively.
Interesting.
And this approach, it directly addresses what Alicia Garcia Herrera over at Natixis SA called Asia's dilemma in a Bloomberg report. Most Asian economies are kind of caught in this difficult balancing act. They depend heavily on U.S. final demand, for their exports. But at the same time, they rely significantly on China's value added in their own production processes, importing components, intermediate goods from China.
So they need both sides.
Precisely. Nations like Vietnam, Cambodia, Taiwan, they're among the most exposed to this balancing act. They find themselves, strategically positioned in a way that forces some really tough choices about their supply chain dependencies.
Okay, so naturally, a big strategic move like this from Washington, it's not going to go unanswered, right? What has Beijing's reaction been?
Oh, they are certainly not mincing words. China's Ministry of Commerce has issued some very strong statements. They've declared they firmly oppose any party reaching a deal at the expense of Chinese interests in exchange for so-called tariff reductions. Strong language.
Wow. So opposition and warnings.
And they've warned of serious consequences, vowing to resolutely counter it. Now, if we connect this to the bigger picture, it raises a pretty important question. Could these individual efforts sort of coalesce into a broader shift, reshaping global trade around, quote, trusted supply chains?
With China potentially on the outside looking in.
That seems to be the implication, or at least the concern. We've seen President Xi Jinping himself, according to Bloomberg, urging the Southeast Asian region to stand together as an Asian family. He pointedly warned against trade fragmentation and division.
And China has a history of responding, don't they, with trade measures?
They absolutely do. Think about the anti-dumping probes on European brandy, dairy, pork after the EU imposed tariffs on Chinese EVs. Or halting Japanese seafood imports back in 2023 after some G7 meetings were seen as critical of China. And the trade restrictions on Australian goods in 2020.
Right.
It indicates a clear willingness to use trade as a tool for geopolitical leverage.
But it's not just Asia feeling the heat here, is it? Europe finds itself in a pretty delicate spot, too.
Very delicate, yeah.
The EU is China's largest export destination for electric vehicles, which is huge. Yet, despite that economic link, trade tensions are clearly rising. European Commission President Ursula von der Leyen, as Bloomberg reported, has even accused Beijing of weaponizing rare earths and magnets. What does that actually mean to weaponize minerals?
That's a really crucial term to unpack. When von der Leyen uses weaponizing in this context, it points to China's dominant position in the global supply chain for these vital minerals. China controls a huge chunk of the world's production and processing of rare earths, and these are essential for everything from smartphones and EVs to advanced defense systems.
So basically, they could threaten to cut off supply.
Exactly. To weaponize them means Beijing could potentially restrict access or impose punitive export controls, effectively using their market dominance as a powerful geopolitical lever in trade disputes. It's about leverage.
Okay.
And this feeds into why diversifying reliance is such a key strategy now for the U.S. and its allies. Beijing is particularly concerned, for example, that the EU might sign up to provisions similar to those in the UK's deal with the U.S. Those included commitments around supply chain security, export controls, basically solidifying this trusted network idea.
Right, but it's not all tension, is it? I saw something about semiconductors.
Ah, yes. That's an interesting counterpoint highlighted by CNBC. In one specific area, semiconductors, the U.S. has actually lifted some chip software curbs on China recently. Companies like Synopsys and Cadence have restored access. It seems to be part of this broader, albeit fragile, trade truce. It shows there are still specific areas of negotiation, maybe concession, where economic interests align, at least temporarily.
Complex. So with all these dynamics swirling around, what does this mean for that upcoming July 9 deadline? Washington is set to impose a, 50% tariff on nearly all EU products unless a deal is reached.
That's the looming deadline, yes. A massive potential tariff hike.
Seems like the EU is caught between a rock and a hard place.
They absolutely are. Look, the EU clearly sees Washington as the more important strategic and economic partner. The numbers back that up.
Yeah.
EU exports to the U.S. are worth more than double the amount they export to China.
That gives the U.S. huge leverage then.
Significant leverage, yes. It forces Europe to prioritize its relationship with Washington, even as it tries to, carefully navigate its complex trade ties with Beijing. It's a real strategic tightrope walk for them.
Okay, let's shift gears now. Let's move from the intricate world of global trade to the domestic U.S. economy. Some equally significant things unfolding there, particularly around jobs and a massive piece of legislation.
Yeah, and what's truly fascinating here, something reported by both CNBC and Reuters, is the stark contrast in market reactions to the latest jobs data. The U.S. economy, quite surprisingly, lost private sector jobs in June. This is according to ADP, the payroll processing firm.
Lost jobs? I thought economists were expecting gains.
They were. It marked the first contraction since March 2023, a loss of 33,000 private sector jobs when, as you said, economists had broadly expected an increase, maybe around 100,000. So quite a startling miss.
Okay, 33,000 jobs lost. That sounds like bad news, yet Wall Street seemed to just shrug it off. The S&P 500 hit a new closing high.
Exactly. Shrugged it off and rallied.
It makes you wonder, though, if the market is celebrating, and the supposed good news is potentially cheaper shoes from Vietnam because of that trade deal, who's going to afford those shoes if they don't have jobs?
Yeah, that's the million-dollar question, isn't it?
Does this mean the market's overly optimistic? Is there a risk of a disconnect here between Wall Street and Main Street, leading to maybe a sharper correction later?
It's a crucial point, and it really highlights the sometimes paradoxical logic of financial markets.
Yep.
This reaction, markets up, jobs down, it seems counterintuitive, right? But it reveals this critical disconnect you mentioned. Wall Street often isn't reacting directly to Main Street's immediate struggles. They're reacting to what they think the Federal Reserve will do next.
Ah, the Fed. So bad jobs news means the Fed might cut rates sooner?
That's the interpretation, exactly. Weaker jobs data often increases trader expectations for the Fed to cut interest rates earlier than planned. And lower rates historically act like, rocket fuel for asset prices. Makes borrowing cheaper. Boosts corporate valuations.
So traders are betting on a rate cut.
They're already pricing in about a 25% chance of a cut in July, according to market indicators. But as Chartuinata at Saxo noted to Reuters, what used to be this simple bad news is good news formula, well, it could now just be seen as plain bad news if genuine recession concerns start to really take hold.
Right. If the Fed doesn't deliver what the market expects.
Then that optimism could unravel very quickly. It shows how fragile market sentiment can be when it feels detached from, the real underlying economic indicators.
Okay, adding another layer to this whole domestic picture is the drama around President Trump's massive tax and spending bill, the mega bill, as it's often called. House Republicans just got it over a key procedural hurdle, right? Bloomberg and CNBC reported they held a vote open for hours past midnight. Sounds intense.
It does, yeah. That vote marks a really significant win for the Republican leadership, especially given the internal party divisions that almost derailed it. And the bill itself is quite sweeping, contentious too. It extends those 2017 tax cuts, puts more money towards border security.
But it also includes cuts elsewhere.
Yes, controversially, it includes cuts to health insurance subsidies and some nutrition programs. So its scope is very broad, touching a lot of aspects of the economy and, frankly, individual lives.
And what about the cost, the national debt implications? I saw some pretty big numbers.
Yeah, sources like Bloomberg are highlighting significant concerns there. The Senate version, apparently, adds a staggering $3.4 trillion to the national debt over 10 years. That's significantly more than the House's initial $2.8 trillion proposal.
Wow, $3.4 trillion. Okay, let's bring it back to you, the listener. On a more personal level, the bill includes some new tax deductions. Things like car loan interest, overtime pay, a senior bonus. Can you help us understand how those might actually affect someone's finances?
Sure. It's really important to look beyond the headlines on these deductions, because while they sound broadly beneficial, as CNBC's personal finance reporting often points out, their impact isn't evenly distributed. Deductions primarily work by reducing your taxable income, so their actual dollar value to you depends directly on your tax bracket.
So higher earners benefit more.
Generally, yes. If you're in, say, the 37% tax bracket, a $100 deduction saves you $37 in taxes. But if you're in the 12% bracket, that same $100 deduction only saves you $12. And for lower earners, people who might not owe federal income tax anyway, or who already benefit from the large standard deduction, these specific new deductions might offer little to no financial gain at all.
So it raises questions about how broad-based the benefits really are.
It does. It prompts questions about who ultimately benefits most from this type of tax policy. Compare that to something like the child tax credit, for instance. That's designed differently.
How so?
It's a credit, not a deduction. That means it directly reduces your tax bill dollar for dollar. And for many families, it can even result in a refund if the credit is larger than the tax they owe. So it tends to be more targeted towards low and middle incomes. There's a fundamental difference in how tax relief gets distributed.
Got it. Okay, beyond these really big headlines dominating the cycle, there are several other market movements, corporate stories capturing attention. They give us a more granular view, right?
Yeah.
One trend Jim Cramer pointed out on Mad Money is the continued weakness of the dollar. It's hit a 4-year low now.
Yeah, a 4-year low. And generally, as Cramer explained, a weaker dollar is seen as a positive thing for big consumer packaged goods companies like Procter & Gamble.
Why is that? Makes their stuff cheaper overseas.
Exactly. It makes their U.S.-produced exports more competitive, more affordable in global markets. Plus, any profits they earn overseas translate into more dollars when they bring that money back home. So it can boost their bottom line.
Okay. Meanwhile, across the pond, the UK seems to be navigating its own pretty severe fiscal challenges.
Yes, quite dramatically. Finance Minister Rachel Reeves's tearful appearance in Parliament, which was widely reported by CNBC and Reuters, significantly rattled markets. UK bond yields spiked, the pound sank initially, though it did stabilize later with backing from the Prime Minister.
But that kind of incident has ripple effects, doesn't it?
Oh, absolutely. It spurred global anxiety about fiscal outlooks more broadly. We even saw an impact on seemingly distant markets, like Japanese bond yields. It just shows how quickly sentiment, especially nervousness, can spread internationally.
And looking further east, wow, the Hong Kong IPO market is apparently on fire.
It really is an incredible surge. New listing volumes jumped 8 times to $14 billion in the first half of this year. That's up from just $1.8 billion in the same period in 2024. This is Dealogic data highlighted by CNBC.
$14 billion, that's massive.
It puts the city squarely on track to potentially become the world's largest listing destination this year, possibly surpassing even NASDAQ in the NYSE.
What's driving that? Is it just a temporary blip?
It doesn't look like it. This surge isn't just about the numbers. It feels like a pivotal shift in global capital markets. It seems fueled by a mix of things. Beijing's strategic regulatory policies are definitely encouraging more domestic listings. Then you have the ongoing delisting fears for Chinese companies currently listed in U.S. markets.
Right, pushing them to look elsewhere.
Exactly. And add to that a burgeoning local AI frenzy in Asia that's driving valuations high. So for investors, for companies, Hong Kong is rapidly cementing itself as a new, very formidable listing destination.
Yeah.
It could really reshape where high-growth companies choose to raise capital in the future, potentially shifting financial power away from traditional Western hubs.
Fascinating shift. Meanwhile, Indonesia is also making some moves on the trade front, right? Planning to sign a big pact.
Yes, a $34 billion pact with U.S. partners expected next week aimed at boosting purchases. This is clearly a strategic play, especially given the broader global trade dynamics we were just talking about.
Trying to get ahead of potential tariffs.
Precisely. As Reuters reported, they were working very diligently to secure a trade deal ahead of that critical July 9 U.S. tariff deadline. This pact is highly significant because Indonesia currently faces a hefty 32% tariff in U.S. markets on certain goods, even though they had a nearly $18 billion trade surplus with the U.S. last year.
So this deal is about mitigating risk.
Exactly.
Mhm.
By signing this agreement, Indonesia is strategically maneuvering to reduce future tariff risks and deepen its trade relationship with the U.S., making sure its products stay competitive in this shifting landscape.
We've also seen some interesting corporate news that ties directly back to policy decisions. Constellation Brands, the owner of beers like Modelo and Corona, they warned their sales are being hurt by President Trump's immigration crackdown.
Yes, it's a very direct, almost striking example of policy impacting business. As reported by Yahoo Finance, executives specifically noted a decrease in the occasions where beer is typically consumed. And maybe more significantly, they spoke about an apprehension among their core Hispanic consumer base about even leaving their homes.
Apprehension due.
Potentially due to increased ICE raids and deportation scares. It demonstrates how social and immigration policies can ripple right through consumer behavior and directly impact a company's sales, even for something like beer. It affects the everyday lives and spending habits of a significant demographic.
Wow. That's a very clear link. And speaking of interesting financial figures and maybe long-term vision, Warren Buffett, he just made another huge donation.
Another remarkable one, yes.
Right.
$6 billion this time,
Hmm.
which brings his total charitable giving over the past couple of decades to more than $60 billion.
$60 billion. That's just an astonishing figure.
It really is,
Yeah.
especially when you put it in perspective. As CNBC highlighted, that $60 billion is substantially more than his entire net worth was back in 2006, which was around $46 billion at the time.
Incredible.
It truly shows the incredible power of compounding over time,
Yeah.
not just for building wealth, but for its potential and long-term philanthropic impact. It's really a testament to sustained investment and having a clear vision, even when it comes to giving back.
What a deep dive today. We've covered so much ground, from those complex global trade negotiations really designed to reshape entire supply chains, to the surprising dynamics of the U.S. jobs market, and the really far-reaching implications of major legislative bills like that mega bill.
Yeah, a lot of moving parts.
We've seen how interconnected all these stories are, haven't we? Affecting everything from potentially the price of your shoes to healthcare access, and even how entire countries like Indonesia are adapting their strategies on the global stage.
Absolutely. This constant interplay between policy decisions, market sentiment, geopolitical strategy, it creates a really fascinating, though, yeah, sometimes volatile landscape for businesses and for individuals like you to navigate.
So as we wrap up this deep dive, maybe something to consider. Given these ongoing efforts to redefine global trade and the significant domestic economic shifts we've discussed, how might these developments collectively reshape the way businesses operate? And maybe even how you interact with the global economy just in the coming year? What stands out to you from everything we've unpacked today? Thank you for joining us for this deep dive. We'll see you all tomorrow morning with new headlines from major financial magazines.